Hello, everyone. Good afternoon, good evening, good morning. Welcome to session 9 of MOOC 14. I hope everyone is well. Today we're going to talk about regulatory affairs. I'm looking at the group chat and I'd like to thank everyone who has shown up for the regulatory session. As in every single time we have ever taught the MOOC for 14 sessions, this is always the smallest group. It always amuses me because I think this might be conceivably the most interesting topic in the course, but the data shows that the demographics of the group do not feel the same way. So nonetheless, we're going to dive in, we're going to have a good discussion. There are some questions we can discuss, and if we run out of time, we'll talk about other topics and see where we get to. So I'm going to jump right into the questions we've gotten so far, and then we'll see what we do after that. So someone asks, I have bought and sold cryptocurrencies for over a year. Paying for the certificate exam was the first time I had ever used Bitcoin to connect with the real world. In regards to jurisdiction, does the local tax law apply to where I legally reside, where the transaction originated? Is Nicosia also taxed the destination point? Is the miner in the middle who confirmed the transaction also taxed according to where they're located? Basically, who or what has jurisdiction over the transaction that I started? This is actually a great question because it seems very, very simple. But from this question, we can highlight a lot of the issues relating to taxation. Now, when we discuss anything relating to taxation, to regulatory affairs, to laws, obviously, I am not a lawyer. I'm definitely not your lawyer. I'm not a tax accountant. I'm definitely not your tax accountant. None of this should be taken as official advice, official guidance, and in any case, I'm going to have to make a variety of assumptions about these stylized examples that might not apply to your case. It's also the fact that the treatment of all these topics varies tremendously by jurisdiction. So I'm going to make some assumptions about jurisdictions, and based on those assumptions, I'll draw some conclusions, but those might not apply in your case. So in all cases, time we discuss anything specific, you can't take it for granted that this is correct, but illustratively, I think it highlights the issues, and to highlight the issues illustratively, that's all we're aiming to do today. So, before I actually answer the student's question, I would like to make a comment to the introduction to the question that the student says, I have bought and sold cryptocurrencies for over a year, and paying for this exam was the first time I'd ever used Bitcoin to connect with the real world. So, generally, the tax authorities will not take the position that this is even correct, that the buying of selling of cryptocurrencies is not in the real world, but paying for a transaction is in the real world. Because what is implied there is that this is the first time this person has to think about taxes. And again, I'm going to assume certain things, and what I'm going to assume, and this might be wrong for this person who asked the question, but it nonetheless allows us to have a good discussion. I'm going to assume that this person is in the United States, they're a U.S. tax resident, and that the University of Nicosia is who this person purchased something from, and the University of Nicosia is in Cyprus and is a Cyprus tax resident. That part I don't need to assume, but that part is definitely true. So, in the United States, if someone is buying and selling cryptocurrencies, that in and of itself is a taxable activity. The IRS treatment for cryptocurrencies is that they're treated as property, and by property that's a very broad rhetoric. So it could be, if you buy and sell a stock, you will have capital gains or losses treatment. If you buy or sell a piece of fine art, you will have a capital gain or losses treatment. If you buy or sell a Ferrari, you will have capital gains or loss treatment. Not if you're using it in your business, or if you're buying it as a collectible. If you buy or sell a piece of land, and so on. Cryptocurrency, and let's assume for the time being this is Bitcoin, is treated the same way. So if you buy Bitcoin at 10,000 a few weeks ago, and you bought a Bitcoin, and today you sold it for 14,500 because it's had a big run up the last few weeks, and you spent 10,000 US dollars to buy it, and you sold it and you got $14,500 back. You have made a profit in very casual terms, right? You had 10, now you have 14,500. For tax purposes, you have a capital gain. And a capital gain in this context, in the US tax code, is, you can see what it means in the name. Your capital has had a gain, it's gained. And it's taxed differently from income. Income tax applies to your labor. So if you go to a job and you're working and you get a paycheck, you get taxed on your paycheck, as is your employer. And if you have a capital asset, like in this case a Bitcoin, and then you sell it for a higher price, you get taxed on the increase of the value. Interestingly, capital gains are taxed at a lower price, at a lower rate than income. And it's an interesting question if that should be the case. The kind of unfairness case against this, it says, well, wow, that seems terrible. You work, and working that everyone has to do, it gets taxed at a certain rate. But that's not even true because it's progressive. But let's say you're a high paid employee, it's taxed higher. But your capital assets are taxed lower. And the counter argument to that is people are not mobile, but capital is mobile. So if you have an attractive capital regime, it will attract more capital to your country. And if you attract more capital to your country, there'll be more investment, more business, more jobs, and more opportunities for everyone to make more income. So there's a trade-off. People are definitely less mobile than capital is. So you might decide it's hard, despite what people say, around election time. It's actually hard typically to pick up and move to another country on a permanent basis. So people tend to stay in the country that they live in, but capital can move around more easily, and so there tends to often be more favorable treatment for capital. Now there's other arguments too, that the capital originally was income and it got taxed then, now it's getting taxed again. Then there's counter arguments to that, but in any case, I think it's fair to assume, for the purposes of discussion, that these buying and selling of cryptocurrencies for the last year were also taxable activities. And if the student had bought the cryptocurrencies at one price and sold them at a higher price, they would be taxed as a gain. If they were bought at one price and sold at a lower price, there would be a capital loss, and that capital loss could be offset against capital gains. So, now let's say, let's go to the specific questions. Does the local tax law apply to where I legally reside, where the transaction originated? So this is a question that there's one very clear answer for American citizens, and then most of the world takes a different answer. If you're American, you're taxed on your worldwide income regardless where you live. So if you live in the United States and you get a salary in the United States and you buy a piece of property in the United States and you sell it in the United States, you get taxed on your income. If you're an American citizen and you live in Tahiti and you buy a property in Tahiti and you sell it in Tahiti, you still get taxed in the United States as if you're in the United States. So if you are a U.S. citizen or tax resident, U.S. tax law is going to apply to your side of the transaction. Other countries have different approaches. They might say your income within the country is taxed at the national level, and your income outside the country, or if you live outside the country, you can just get taxed by that other country. So the answer to that question depends on which country you are a tax resident or citizen of. Let's say you're American. Let's say our student had bought a Bitcoin at $7,000 and then sent $14,000 to the University of Nicosia. Now, the exam he's talking about is not $14,000, but we'll keep our math simple. Under U.S. tax law, that person would have a $7,000 capital gains at that point. Because from a U.S. tax perspective, the transaction is viewed as two different things. First, it's a realization of the profit. We have turned the Bitcoin that has some value, theoretically, unrealized value. It's worth 14,000, but I can't eat Bitcoins. And I am converting it into a product or service, and that's really two transactions. We're realizing the value, that's the capital gains, and then we're just buying the service, which is not taxable. The part that's taxable isn't sending a Bitcoin to the University of Nicosia. The part that's taxable is realizing the value of the Bitcoin. So it would be a capital gain or loss. If the Bitcoin had been bought at 14,000, and at the time that someone sent it to the University of Nicosia it was worth 7,000, there would be a $7,000 capital loss that could be set off against your other capital gains, whether they're in cryptocurrency or any other asset. So I go to the next question. Is Nicosia also taxed at the destination point? The answer is yes. For the University of Nicosia, when they receive money for an exam, let's say, whether they receive it in euros or dollars or Japanese yen or Bitcoin, the correct accounting and tax treatment is that this is income to the University of Nicosia. This is not a capital gains. This is normal income. We are providing the service of giving this certificate. We have generated revenue for providing that service. And the tax authorities, this would also be true in the United States, but it's also true in Cyprus, do not distinguish on the question of if we've received income based on what mechanism our customer used to pay us. By the way, I think it is sensible, right? Like, if you said the University of Nicosia has to pay income tax if someone pays us in euros, but if they pay us in dollars, we don't, well, you can imagine, we're not going to invoice anyone in euros, we'll just invoice everyone in dollars, and woohoo, we don't have to pay any taxes. Well, the tax authorities aren't that silly. They know that that would be a bad system, so that's not how the system is. Well, there's nothing different to say in saying we'd be taxed if we received euros, but we wouldn't be taxed if we received bitcoins. If that was the case, we'd invoice everyone in bitcoins and say, we'll even give you a really big discount to pay us in bitcoins because we save the taxes. So, of course, that's not the tax policy in Cyprus, nor is it going to be a tax policy anywhere else. So, yes, the University of Nicosia is taxed at the time we receive the money. The next question. Is the miner in the middle who confirmed the transaction also taxed according to where they're located? Assuming they're located in a jurisdiction that taxes miner income, the United States would be one of them. The answer is also yes. So the miner receives a block reward and the transaction fees for this transaction. In most jurisdictions, including the United States, the block rewards and transaction fees that the miners received are considered income. They're in the business of mining. Their expenses are buying ASICs and electricity and people to manage their server farms. And their revenue are the block rewards and transaction fees they receive every time they mine a block. So that is also taxed as income. So this one simple transaction is a capital gains or loss for the person sending the Bitcoin. It's income for the miner that confirms it, and it's income for the University of Nicosia who receives it. It's kind of amazing, right? Like the house always wins. This concept that the only sure thing in life is death and taxes, so far in 2020 is holding super true even in 2020. So this is all three steps are taxable. Now the question is, who has jurisdiction over the transaction that I started? Depends on which jurisdiction everyone is and what type of reach that jurisdiction asserts. As I said, if you're a U.S. citizen, wherever you are, you might also have to pay taxes locally, but you're definitely paying taxes to Uncle Sam. If you're a minor, you'll be taxed in the jurisdiction that you're in. Now, it doesn't mean you'll be taxed. So Dubai, for example, I believe has no corporate income tax, if I'm not mistaken. So if you're mining in Dubai, Dubai would be the jurisdiction, and you have no income tax. But the rules have to do with the jurisdiction that you are in. Okay, let's go to the next question. This next question is like the hardest question in crypto financial services. In a situation where an MSB or jurisdictionally correctly registered digital currency services provider is registered or not, how is the appropriate jurisdiction and legal application pitfalls and filters selected in decision making of where to be based to be judged legally compliant if, say, the entity/company providing the service is based/registered, say, in the Cayman Islands. The servers of which the actual processing occurs are in Malta, and the end user and his computer, where the service is being consumed, is, say, in Slovenia. So the official answer to this, it depends, and nobody really knows, right? And then it all depends on a bunch of facts and how aggressive your jurisdiction is. But let's try and unpack it a little bit. I believe there are both theoretically correct answers and practically correct answers. You see this if you go on a lot of exchanges. They will say you are not allowed to sign up if you're in one of the banned jurisdictions. And in many cases, the banned jurisdictions are things like, North Korea, Cuba, Iran, and the United States. It's kind of like a weird set of jurisdictions to be banned. And the reason it's like that is the first three are because there's various sanction regimes against the first three, and the service providers, banks, don't want to be doing business with those sanctioned countries, and so they've told the service provider, forget it, we can't take inbound, outbound wire transfers to these countries. And the fourth is not that the U.S. is sanctioned, but the U.S., this is the service provider trying to avoid coming under U.S. jurisdiction. So, let's say you're in the Cayman Islands. And let's keep your servers in the Cayman Islands for a moment. And you don't want to comply with American legislation. Do you have to? Or do you not have to? Well, let's say an American logs on to your website. Let's say you've done nothing. It's your normal website. American logs on, starts trading. I believe the position of the United States would be, well, no, you're doing business in the United States. You are providing securities or MSB type services to an American customer. You have to follow American rules if you want to do it. Okay, let's take it a step further. You have the same website, and on the website sign up form it says, don't sign up if you're American. I believe, and again, I'm not your lawyer, the situations depend, and blah, 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 blah. probably not enough. It's probably, you don't get to avoid all your U.S. obligations by saying, ha ha ha, you can't sign up if you're American, and then turning a blind eye if a bunch of Americans are signing up. Next step, you say that, and you also ban anyone with a US IP from accessing your site. And now we're getting somewhere. Right? That's may or may not be enough, but that's starting to feel like a little bit more like a good faith effort, right? Because if you say, we don't want any Americans to sign up, but you can sign up just fine from the United States, it's hard for some third party to believe you're not just pretending you're not signing up Americans. Let's take it a step further. You do all of that, and then you KYC the customer, and you require that they show you an official form of ID, and if the only form of ID they have is American, you say, no, I'm sorry, I can't serve you, you're a U.S. customer. So like if you are in the Caymans, and you say you can't sign up if you're American, and you're IP blocked from American, and you have to show a form of ID that's not American, and you certify you're not American, and if some American slips in anyway, and again, I'm not your lawyer, and etc., 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 you're probably okay. You've made a good faith effort to block it from Americans, and now the person who signed up has lied to you. If you effectively make no real effort to ban Americans, and just somewhere in your terms and conditions it just says, oh, we don't want Americans, I believe the Americans are going to come and say, oh, well, you're providing these services in America. Okay, then what happens? Well, it depends. And it depends on a lot of factors. Some people might say, well, I'm going to provide these services in America, and I don't care. I'm in the Cayman Islands. And let's say it's known who you are, right? Well, then you get into interesting questions. Are you an American citizen? Do you travel through the United States? Are you the owner, the director of the company? Do you travel through the United States? Does the U.S. have an extradition treaty with your country? Does the extradition treaty apply to these types of, let's say the U.S. charges you with violating the MSB rules? Can you be extradited for this topic? You know, certain exchanges and their directors have been swept up in American investigations and criminal investigations because they were transiting through an American airport. And so here's where I say there are kind of the theoretical aspects, but there are also practical aspects. Let's say you wanted to play close to the line, you wanted to be cute. And this is not a recommendation, by the way. Like, none of the... I don't think in the end the big businesses that are going to be built here will do that, but we'll see. Probably best if you're trying to avoid a jurisdiction, let's say it's the United States, that you're not American, that you're not coming to America, that America doesn't have any access to you. And, you know, okay, you can do that, of course, but then it creates other difficulties, right? Because a lot of things run through America. And a lot of the banking systems, the correspondent banks run through America. Probably won't be able to correspondent bank through the United States, and so on and so forth. So it gets very tricky. It gets very tricky when you're trying to say, I am avoiding a certain jurisdiction's laws. Now, let's go to even more obscure cases. You're in one location. Oh, by the way, you know, it says the question is based / registered. The registered here is a code word, right? Like the registered means I'm not really there. I've registered a company there, but I'm living in Denver, I'm living in Slovenia, I'm living in the UK. The way the international environment is evolving is away from these types of arrangements, right? So the ones that don't, if you say, I've put my hat on, my Cayman Islands hat on, and what does that mean? I went and registered a company, and it has a registered office, and you're with 10,000 other companies, and we don't actually have any employees there, and the directors aren't there, and the board meetings are there, and we don't have any operations there, but I'm a Cayman company. And again, of course, this still happens from a lot of companies, but it's people are frowning upon that these days. If all of you are living in the Caymans, residents of the Caymans, have offices, employees, blah, blah, blah in the Caymans, working in the Caymans, have a substantive presence in the Caymans, it's different. You might, in fact, be treated as being in the Caymans by a larger number of jurisdictions than if you just register a company there. And to what degree it matters has to do with what you're doing, how important is what you're doing, and what jurisdiction you're in, how aggressive your jurisdiction is. So let's say we're really in the Caymans, we're not just registered in the Caymans. But Caymans doesn't have good data centers, and your data centers are now, in examples, Malta. Are we also in Malta? Are we also in the European Union? We'll get the fully unsatisfying legalistic answer. Maybe. Right? Might be. Have you now made yourself subject to GDPR? Maybe. Are you subject to GDPR if you're serving EU citizens even if you're outside the EU? Yeah, probably anyway. Does something change if you keep the data in Europe? Maybe. Is it worse? Maybe. Is it better? Maybe. But it probably needs to be studied in your specific case, because now you have some aspect of doing business in Europe, right? It might not matter in your specific case, I don't know, but it could. It's definitely not a certain, no, don't worry about it. That's for sure. It might be after study, don't worry about it, or it might be after study, it has negatives and positives, or positives and negatives, or it's neutral, but it would have to be studied for your specific usage case, under which laws you're working, and so on, which jurisdictions. Now, we mentioned Slovenia as the customer. And let's take Slovenia as an example of an EU member state. And the difference in the United States is the rules on cryptocurrency in the EU, I think on the whole, are less developed because certain jurisdictions have made a lot of progress. Certain other jurisdictions have made no progress whatsoever, and some others are in the middle. So it's very possible that with some jurisdictions you might not have an issue today because no one's gotten around to thinking about it. Or if even someone's gotten around to thinking about it, they haven't gotten around to drafting legislation. And even if they've drafted legislation, they haven't gone around to passing the legislation and then enforcing the legislation. It's in process. Do I believe in time there will be legislation in all developed countries on this topic? Yeah, I think so. Will it become progressively more harmonized across the EU? Yeah. And so it might be the case that today in Slovenia, and I have no idea, right? Maybe Slovenia might have very advanced blockchain legislation I haven't noticed. But it might be the case that there's not much, but there might be in a few years. And so my sense is, under most conditions, if you're going to build a digital currency services business, yada, 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 you are going to end up being regulated. And regulated probably in multiple locations. It's probably not a get out of regulations free card just to say I'm parking myself in the Cayman Islands. That probably doesn't get the job done, right? So, but this is, I think, the actual hardest question in crypto, because you could run into a situation where all of the above want to regulate you, which is possible, and they all have different rules. And that's difficult, right? If they all have the same rules, if all of them say, you need to KYC your customers, you need a driver's license if you're going to sign someone up, well, okay, fine. If you're doing it anyway for the Caymans, it's going to count for Malta, it's going to count for Slovenia. If, on the other hand, it is one of them says do X and the other one says do the opposite of X, then you end up in a really tricky situation, right? Like, there are, I believe, possible situations where it's impossible to be legally compliant in both jurisdictions at the same time. Okay. Next topic. This one comes with a warning. It's called Crazy Question. Do you know of any type of business in the crypto space that can avoid all these heavy-handed and excessive burdens from regulators? Honestly, it is frightening. And then there were some question answers in the forums, which I'll come to. But before I go to the actual answers in the forum, yeah, sure, I can think of some. If you are using a blockchain or a token for non-financial purposes, probably pretty light regulation, right? Like, I don't know, I want to give coupons to Pizza Hut on a blockchain. I think you have to apply with whatever rules apply for giving coupons for Pizza Hut on a piece of paper. But you've probably not ended up in the world of securities legislation. Right? What this question really is, though, is, I think, can you do crypto-like, securities-like, token-like stuff and not actually deal with this stuff, this regulation? I believe the short answer, practically speaking, is no. Okay? That's my sense. And I say this in the context of scale. Do I think, because the question is, can you build a business? If you build a business, you're going to eventually have a company, employees, people, visibility. People will notice you exist. And if you're in a country that regulates these types of activities, someday they will find you and say, hey, what are you doing? And you're going to say, I'm doing this. And because you're going to have to say you're doing this because you're building a business, right? If you want to run the XYZ exchange, presumably you want customers. If you want customers, you have to advertise that you're running this exchange. If your customer can find you, so can your friendly regulator from FinCEN. Someone's going to knock on your door and say, hey, I appear to be running a money service business, and I looked down my list of who submitted an application and got approved, and I don't see your name on it. And then all types of unpleasant things tend to happen at that point. On a micro scale, could I do what? What could you do on a micro scale that never hits the radar screen? I think it's difficult, right? Like, even if you say I'm going to freelance and just get paid in Bitcoin and never what? Okay, you have the Bitcoins. Okay, you're not going to sell them now because you want to stack sats. Great. At some point you're going to sell them, right? Like, presumably you're not going to live 50 years and then pass them on to your kids and they live 50 years and nobody's ever going to use them. I mean, I assume it's not just an exercise in seeing the orange number go up. Presumably people invest because they want to make money, just like they invest in stocks, and at some point they want to use that money to go on vacation or buy a house or pay for their medical treatment or whatever. So at that point, even if you've managed, you are working off of the books, you gave someone an address, you did your operational security perfectly. And by the way, I'm not recommending any of this, but let's say you did. You did everything perfectly, and there's no way to trace that address to you, and you've gotten 2 Bitcoins, and now you have $28,000, and you hold it for a while, and it becomes $100,000. Okay. I agree, if you did everything perfectly, which you're probably not going to, that 100,000 may not be traceable to you. Maybe. Big question mark. But what happens when you spend it? Of course it's going to be traceable to you. Right? And then when you spend it, and it's traceable to you, then you have to explain I mean, again, if you get audited and blah, 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 blah. Oh, where'd you get it? Oh, well, someone gave it to me 5 years ago because I did this project for them. Well, I don't see it on your tax return. Right? So, generally the idea that you can operate unregulated, untaxed on a crypto blockchain, I am skeptical. Now, the common answer, this was the answer in the forums, go on Uniswap. They can't stop you. It's a contract that's running on Ethereum. It's true Uniswap cannot freeze your money due to a kind of request from a regulator. That part's true. And they won't KYC you, etc., etc., etc. I agree that you can do transactions in Uniswap and they're unstoppable, uncensorable, let's say. But the problem still is the same problem I just described. How did I get my tokens that I put in Uniswap in the first place? Right? How? I bought them. Who did I buy them from? Who took my money in exchange for giving me Ethereum? Does that person not care who I am? I don't know. Might. Do you know that person is not with some type of regulatory authority? Did I earn them? Well, who paid it to me? The person who paid it to me, don't they want to write off their expenses? And then anyway, so I got them in, and somehow I got them in, but I don't see how you didn't interact with the real world to get them in. Okay, fine. I went to local Bitcoins. We met in a dark street corner. I handed the person cash. They sent me a Bitcoin. Okay, I mean, let's say you did that. And let's say you got it in. And let's say you weren't worried. They don't know it's you. You go to Uniswap. You trade, you farm, you this, you that. Your 1 Bitcoin is now worth 5. You are the new hot account on crypto Twitter, right? Now what? Right? And I'm watching the comments. But I don't want to go back to fiat. My argument is not that you want to go back to fiat. My argument is that you, whoever you is, live in the physical world. And at some point you're going to want to consume goods and services. My point is not whether fiat can be traced to you. You say, I'm never going back to fiat. I'm going to go into a stable coin. I'm going to go this. Okay, fine, you do that. You now have a stable coin. You now have something else. But you live in the physical world. You don't live on the Ethereum blockchain, right? You yourself are not a contract. You're not a smart contract on the Ethereum blockchain. So, I'm not going to go back to an exchange. I am going to send it to someone else. I am going to send it to someone else who's also on a decentralized exchange. Okay. Which of the goods and services that you're really going to want will you be able to buy that way? Can you buy a house that way? Right? I own a house. When I sell it, I have to go to the land registry office, declare the price I was paid for it, file it on my taxes, blah, 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 blah. And say, where's your documentation? Here. I got it from here, blah, 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 blah. I go to my Ferrari dealership. I'm rich now. I've been trading on crypto Twitter. Hey, I want to buy this car. I'm going to pay you with untraceable crypto. Okay. No one's going to sell you a Ferrari on those terms. But let's say they do. And after I pay you with untraceable crypto, the other side of the transaction is going to be registering a car with my name, my driver's license, my insurance company, and 100 other things. So you'll be de-anonymized the second you drive off the lot. Right? Even if your Ferrari dealership decides for some reason they're going to take untraceable crypto, which they won't, but let's say they do. The other side of the transaction is de-anonymized. Because to drive a car, you need a driver's license, you need insurance, you need blah, 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 blah. And so the hotels, restaurants, expensive cocktails, clothes, refrigerators, etc., 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 etc. The vast majority of things you want are going to get because you're interacting with a business and because businesses interact within the regulated financial system and because they're going to have to report the income because otherwise they're engaging in tax evasion, right? You will get de-anonymized at the point of purchase. And so it takes a lot of care to think through all the way to the end, because otherwise the early steps, and I say I'm very skeptical of most people's ability to actually do this on a fully anonymized basis. I think most people will de-anonymize themselves on their way in. But it's important to think of what your way out is, because if your theory is, oh no, I'm going to go anonymous on the way in, I'm not going to declare this stuff. I'm not going to declare my capital gains and losses because they won't find me. Well, ask yourself, what are you going to do with this stuff at the end? And when you do whatever it is you're going to do with it at the end, are you going to get de-anonymized there? And if you get de-anonymized there, if the prior transactions get de-anonymized, did you have to declare them? And are you going to have penalties and fines and interest and all these other things? Now, all this depends on your jurisdiction, right? Like, your jurisdiction might be Dubai and none of that stuff is taxable, and then that's great. Right? So you can do all these things, whether it's anonymous or not anonymous, but it's still tax-free. And so maybe one conclusion of this is, if you're not an American citizen, which means you get taxed anyway, we should all move to Dubai. And then we can crypto trade all day and it'll be free. Right? It's possible. Right? That's one solution. And so then you don't actually care about if it's anonymized or not anonymized. Now the comment continues. And I was thinking part above the table, part below the table, etc., etc., etc. Look, it's like cash today. In theory, but in practice, some people do some small-scale tax evasion by paying in cash, right? You go to and this is in less institutionalized context, right? You can't go to the Apple store and say, I'd like an iPhone. Look, I know it's $1,000, but what about this? You hit my credit card for $500. I'm going to give you $400 cash. Apple's not going to get taxed on this $400, so you're going to give me $100 off. Right? Obviously, we get laughed right out of the store. Right? And so for many things that we buy today, this is anyway irrelevant even in cash. Now, you're buying from some small vendor in some market somewhere, could you say, here's the price with credit card, here's the price with cash? Sure. But can you do major life things that way? Can you live your life day to day? Not really. Not in any meaningful sense. Not in any scaled sense. And cash, I remind you, is much more anonymous than crypto. Cash, if you've done the transaction and someone hasn't caught you then, it's probably over. Crypto, it's always there. And so you might be anonymous today and get de-anonymized in the future because you've left, as we learned, a permanent record, unalterable, highly redundant of anything that has been done. So, and I've discussed this every MOOC, I discussed it in one of my classes too. I think I emphasize this and I go on this tangent because I would like to encourage people to think about this very, very carefully. That it's actually not a good way to do tax evasion. Right? And I'm making 2 points. I'm obviously not in favor of you doing tax evasion. But my additional point is crypto is a bad way to do tax evasion. If you decided you were in the business of tax evasion, which I do not condone, right? crypto is a bad way to do it, because crypto is highly, highly permanent, right? So so then what you should think about instead is tax planning. Now, what does that mean? Well, I'll tell you. It is, an American could conclude that doing a lot of transactions with Bitcoin under the current rules is compliance annoying, which it is. I think that's why you have a lot of holders in the US, right? Like, this whole dream of 2012, 2013, we're going to buy our coffee with Bitcoin and all this stuff. The way the US rules are right now is, I think, impractical. Because every time you buy that coffee, you need to calculate the cost basis of your crypto and then find if you had a gain or loss and report it on the end of the year on your tax statement. It's impossible, right? Like, why would you put yourself through that mental aggravation? So we get a lot of holders. In Brazil, on the other hand, I think there's a $5,000 floor below which, or floor, I guess. If you have less than $5,000 of transactions, you don't need to track it for tax purposes. So if you're a Brazilian and you're in Brazil, go ahead and buy a coffee with Bitcoin or Ethereum or Litecoin. It's fine. You're not going to have the tax overhead. In the US, you're going to have a lot of tax overhead. Coin Center, which is a big lobbying group for the crypto industry, is trying to make this de minimis exemption one of their priorities. De minimis means small. Right? The de minimis exemption exists in the US tax code for foreign currencies. So if you go to France and you exchange your dollars to euros, you buy your tchotchkes at the Eiffel Tower, and then you exchange your euros back to dollars, well, because the exchange rates moved, you're going to have a gain or loss. And on a personal level, the gain or loss can be ignored if it's less than $200 a year. And that is literally just a practical consideration. It's not that there's a theoretical basis that says gains or losses below 200 shouldn't or shouldn't be. It's just saying, look, people go on vacation, people exchange foreign currency. It's a nuisance for everyone, both the IRS and the taxpayer, to have to track all these things. So if you're George Soros and you've made $1 billion on betting on the pound, we would like to tax that. If you're Mike Smith and you just bought your I Love Paris t-shirt and you had a currency gain or loss doing that, we don't care, right? So I believe this is something that should happen. I think it would be a good exemption to exist in the law. I'll give you another tax planning consideration. I keep going to the US because I'm more familiar with the rules there, and anyway, they're among the more complicated, so everywhere else are easier. Right, again, if you're in Dubai, they don't tax anything, then your tax planning is very simple. You could consider putting your crypto trading in a tax-deferred account, right? One of your retirement accounts, where you don't pay taxes until the end when you take them out. That way you can trade tax-free, right? So it's important to have a realistic, the spectrum is not, I have to pay taxes or I don't have to pay taxes. My sense is, at the end of the day, you're going to have to pay taxes, right? Like this is death and taxes. They're always there. If you conclude that at the beginning, then you can do tax planning. Then you can say, maybe I should trade in a tax-free account and hold in a taxable account. Right? So think about this, because I think this is a very sensible idea. Let's say you have, your portfolio is 80% Bitcoin and you're holding that for the long term. And 20%, you're out there trading every altcoin that shows up on Twitter. You're trading 5 times a day. Right. don't recommend this, but let's say that's what you're doing. If you have the ability to do this, you can hold the one asset in the taxable account because you're not going to have any transactions for a long time, and put the other ones in the tax deferred account so you don't have to be taxed on 1,500 transactions a year. By the way, almost certainly if you do that type of day trading, you lose all your money in that anyway, so you'll end up with tax losses. But hope springs eternal, and so people do that. So I think you should think carefully about this. I think you should be compliant. I think if you're compliant, there is plenty of tax optimization one can do that is within the law. And also, it just simplifies your life. It's just trying to spend multiple years staying ahead of the law on not getting de-anonymized on your crypto. It's tiring, right? I'm trying to imagine if I had to do that, and I think I know enough about crypto and about tax to have a realistic view of what that would take, and I'm exhausted just thinking about it. Right? So I suspect you will make more money in the end by taking all that energy you would otherwise spend to go around it by just doing other productive things and just earning more money, is my guess. So we have a couple more questions. Let me see if I can get to them. The first question is, what would an SEC ruling mean for an early investor in a digital asset if it were to be classified as a security? Would they have legal recourse against the common enterprise, whether based in the US or elsewhere, if the value of the digital asset had dropped considerably? This is a very sophisticated question, a very good question. I think the answer is probably yes, but with high transaction costs. Right? Like, if you invested, and you got to find the people, right? So if it's truly a decentralized security, you're not going to find anyone to sue. If it's one of these, it was actually a company and they launched a coin, they tried to pretend it was decentralized, and the SEC said, no, this is just a security and you're a company, and we have this finding that you were in fact a security, and we've now fined you $5 million. That's probably pretty useful to you if you want to file a civil suit against that company and say, you sold me an unregistered security and I lost my money and I want to get compensated. Practically speaking, though, that's only going to work as a class action lawsuit unless you have a lot of money that you can just afford to litigate it by yourself. If you have that much money, I suspect you're not asking me this question in the forums, right? So if it's the amount of money that we're having this discussion, the only chance that this is going to be economically viable exercise is to have a class action lawsuit, get certified as a class, have lawyers act on behalf of all the class. It's going to take a long time. You got to hope that the common enterprise actually has money to pay for you. The lawyers are going to take a big chunk of it, and that then maybe you'll hopefully get something. So I think it's a theoretically yes, but with practical difficulties, which may be surmountable depending on the situation. Right? So I would look for a lawyer that is well versed in this field. Is it possible to avoid paying capital gains tax, or at least pay less, by injecting the money as capital to your own business startup? I'm based in the UK, thanks. I don't know the UK tax code, so I'll answer from the US. I think this question is the following. I bought a Bitcoin. It was $1,000. It's now $15,000. If I sell it, I'm going to get taxed 20% or something on the 14,000 gain. So I'm going to be left with like 10 grand, and now I have 10 grand to start my business. Can I find a way to start my business and have 15 grand to start my business by saying I am contributing that Bitcoin to my business? The reason this question is being asked is if you contribute cash to your business, that's not a taxable event, right? So if I'm starting a business and I want to put my initial equity in my business and I contribute capital, 10,000 cash, I take it from my bank account to put in my business, that's not a taxable event. I think it would be a taxable event in the United States. I think they would say it's a realization. Now, if not, though, if it's not a realization, I don't know if it would be a realization then when the business sold the Bitcoin in order to use it. Right? Because to avoid tax, you would want to hope that the following thing happens. You don't get taxed as an individual basis. The company gets a cost basis of the current price. And so even if it then sells it at the current price, the company doesn't get taxed either. I don't want to say it's not possible, and it might be possible in one's jurisdiction. It has a sense of being slightly too good to be true, but it might be possible. That's worth checking with a tax advisor based on your jurisdiction's rules. If you actually need the money in the startup, if you're just looking for this as a way to get your money on your crypto untaxed, well, then you got to take it back out of the company. When you take it back out of the company, it's going to be salary income or dividend income, and salary income is for sure taxed higher than capital gains, and dividend income usually about the same. So that's just going to be a round trip without any benefit, even if the other parts work. My sense is the other part doesn't work in the United States, but I don't know. I wouldn't actually put my hand in the fire on that topic. So it might be worth checking out. But it feels a little bit free lunch to me, so I don't know. Free lunches don't tend to exist. All right, last question. How can tax authorities find out which operations with crypto a person has done, or if he's in profit, since there's so many worldwide exchanges and so many altcoins? Someone can buy Bitcoin altcoin in a U.S. exchange, but final revenue get an altcoin sold in a Korean exchange. And if this person is residents of Australia, how do tax authorities track all that? Well, sure. They might not be able to track it well now. They will get better over time. The FATF, Financial Action Task Force, is applying, in fact, stricter anti-money laundering rules to crypto businesses than to banks. Eventually, all these crypto businesses will, the Korean exchange, the Chinese exchange, the Australian exchange, will report back globally. It'll take time, not yet, but it will happen. And I come back to my other question. Okay, I've got another altcoin in a Korean exchange, but I'm in Australia. Cool. Now what? I assume at some point I need to consume goods and services in Australia. So that altcoin has to make its way back to Australia. And even if all the exchanges around the world haven't reported back to you, you'll get de-anonymized on the back end. So it's a variation of the same question. Okay, we are out of time. I think I actually got to all the questions. I'd like to say the following, because if I'm not mistaken, Dimitri, this is my last session this time, and I will be handing you off to the gentle hands of Professor George Yaglis for the last 3 sessions. So I want to say, as always, it was a pleasure teaching you as a group. As always, I find this very enjoyable, including your questions. Some questions repeat time after time, but some questions are new. And so it's always useful and helpful for me to think about them and push my thinking. And I always learn something just from the questions that are asked. As I said in the beginning, I want you to consider you are now members of the University of Nicosia family, wherever you might be. And please stay in touch with us in one of the many different ways that this can happen. I hope we see some of you on the course. I hope we see some of you on our online seminars. I hope we see some of you in person once COVID allows us to travel again. And I want to say I think this is a super exciting area. I think we're nowhere near the end of development. We're not even towards the end of the beginning. We are still at the beginning of the beginning. There'll be decades of development in this space, and we're still at the beginning. So a lot of interesting things to be done. Go do interesting things. As we said today, try not to get tripped up on the regulatory stuff. It's a shame for that to be the case. It's manageable if you think about it in advance. And hope you Hope you have found this useful, helpful, and again, I hope you stick around and we get to spend some time with you. So thank you everyone once again, and have a great day.